I'm Charlotte McLeod with investingnews.com, and here today with me is Justin Huhn, founder and publisher of Uranium Insider. Thank you so much for being here. Great to have you.
Good to see you again, Charlotte. Thanks for having me again.
Really good to be catching up with you. And as usual, we have so much to go through in terms of what's going on with the uranium market. But I thought we could start a little bit simple and just take a quick look back at 2023 and how the year turned out in terms of supply and demand, what that balance, or more correctly, imbalance, is looking like as we head into this new year.
Well, 2023 had a pretty substantial deficit for supply. I think that's going to shrink a little bit for 2024 with the ramping back up of Cameco's McArthur River mine, which was on care and maintenance for 4 years. They restarted that and got that up and running last year. Didn't quite hit their target, but they didn't miss by that much at McArthur. And they expressed in their Q4 call that they intend to ramp that up to the mill's full capacity, which is 25 million pounds a year, which I think they'll achieve, but it's going to take some time and it's going to take some investment. But last year we were looking at somewhere between 130 to 135 million pounds of primary production and approximately 180 million pounds of primary demand. Those numbers, of course, especially the demand number, can be largely skewed based on tails assumptions for enrichment. That's a little bit of a complex topic, but if we give it a relatively conservative tails assumption for 2023, we're looking at right around 180 million pounds of demand. So a very, very large primary deficit between supply and demand. Of course, there's both secondary supply and secondary demand, and some of the secondary supply, the primary source of that is enrichment underfeeding. Now, in the West, for Urenco and Orano, which are the enrichers that provide material that are enriching in the West, they had essentially no underfeeding last year at all. And that's going to be the same for the next few years until they have expanded capacity or demand slows down, which it doesn't seem like it's going to, according to the news flow that we're seeing almost on a daily basis. Demand looks pretty robust and growing. So basically no underfeeding the West, but there was some underfeeding coming out of Russia and probably a little bit out of China, but that material doesn't really come into the market, but you still have to count it as supply. So let's say 10 to maybe 15 million pounds of secondary supply last year. Some of that was inventory. We did hear about some Japanese utilities selling a bit more inventory last year. Certainly that didn't put much downward pressure in the price of the commodity because we saw the commodity go from low 40s per pound all the way to $90 a pound last year. So it basically almost doubled in over the course of about 6 months. But yeah, so secondary supply on top of primary supply, let's just call it 150 to maybe 155 million pounds against 180 million pounds of actual demand. Then, of course, we did have some secondary demand, and you could count that primarily as financial buying, purchasing from Sprott Physical Uranium Trust, from Yellow Cake, from Zuri Invest Fund that they just started up last year, from some individual hedge funds, things like that. So still on balance, we believe there was about a 40 million pound supply deficit all told last year. That's going to shrink a little bit this year, but we don't know how much financials are going to be buying. We don't know how much inventory restocking will be done, because that 180 million pound number from last year, which probably you can push that up to 185 at least, maybe even pushing 190 this year based on higher tails assays, both transactional and operational. But if you consider that inventory restocking, actually buying more uranium than you need as a nuclear fuel buyer for your utility, for your power plant that you're operating, that's technically sort of secondary demand. That's above and beyond that run rate capacity, structural demand from the operation of the plant. It's actually inventory restocking. That's typically what does happen in an environment where you have rising prices and an actual deficit, let alone a perceived deficit. So we have a very large supply deficit in this sector that's going to persist for a number of years until we have either some kind of shock that lowers demand, which is impossible to predict or model out for. It doesn't appear like we're going to see anything like that. Or B, a much larger influx of supply, whether that's coming from aggressive selling of inventories, which the opposite has been happening. We've gone from $18 a pound all the way up to above $100 a pound since 2016 to the present day. And we have seen less material come into the market, not more. as the price rises. So that's where we're at with that. New mine supply, mine restarts, the gears are turning, the market's starting to respond to higher prices. It's just going to take years before we have the big new mines and the big expansion coming from possibly Kazatomprom in Kazakhstan, until those can even come close to balancing this market.
Okay, thank you for going through that. I know probably many people in our audience will be familiar with those numbers, but I think just it's good as we start the new year to lay it all out there and get the full picture. So really good to get into that. Now, looking at more recent news, and I know this is not maybe as recent as it was Cameco's results news, but when I told our audience you're coming on, this is what they wanted to hear about. And I still see a lot of commentary on Twitter, people talking about this. So I want to get your take on Cameco's results. I think it's clear at this point that people didn't really like what they were seeing, but I saw on Twitter you commented, some of these takes are a little bit harsh. So I'm wondering what you felt was harsh, what you thought was merited, if we could go into that.
I think what I was reacting to as being harsh was just kind of like public trashing of the company based on contracts they had signed in the past and their actual realized prices here. It's pretty easy to understand that a large operating company with hundreds and hundreds of employees and extremely complex mining operations that went through a very, very painful period of putting McArthur River on care and maintenance for 4 years and paying out a lot of money to keep that on care and maintenance, perhaps to the tune of $10 million a month to maintain that mine, not producing anything, that they really took one for the team, for the industry. And I think that it's important to not forget those sort of things. But it's pretty easy to understand that for a company that was experiencing that difficult period of time, that they had to sign some contracts in a buyer's market that probably don't look all that fantastic in hindsight. But what we have to understand now is there's a delay for the accretive nature of these contracts for a company like Cameco. And this is very different for a developing company that isn't producing yet. They're working on building out a mine. They're bragging about how they're completely leveraged to the upside of uranium prices because they haven't signed any contracts. And that's very easy for a company that's going to produce 1 million pounds into the market. And they're working on development to say these sorts of things and to brag about them. But for a company that has an immense responsibility to maintain operations that basically had their hand forced a bit back, 2017, 18, 19 by the market, that was still trading at a price that was lower than their all-in costs, to sign some contracts just to keep the ball rolling and to keep their operations going. So we're going to see a delayed effect. Now what we're seeing is the company has plenty of cash to exist in this market. They just had this extremely accretive acquisition with a 49% ownership of Westinghouse, which has, according to the company, according to Cameco in this call, a 6 to 10% compound annual growth rate, which is insane. That's an extremely large growth rate. They have an incredible moat with this, and with the intellectual property and skilled workforce that are owned by this company. So they have this whole other aspect of the company that's not just uranium mining, but even looking at the uranium mining side, their inventory built over Q4. So they were able to add inventory. That's a good sign. They've got some wiggle room. So even though they're telling the market that they might have to buy up to 2 million pounds in the spot market, effectively what they're doing is establishing a floor in the market. So we can see the price drop a couple of dollars. They might be in there buying a little bit and putting a floor under that. And what that does is it influences the terms of the contracts they're signing now. So the contracts they're signing now, largely market reference, if not entirely market reference, with very high ceilings. And those are going to keep moving up. And a company like Cameco, with a history of providing into their contracts, meeting the requirements of those contracts reliably for decades, they are going to be able to demand a premium in the term market. Whereas a term contract being signed by a developing company is not going to have the same terms as the contract being signed by a company that is 100% reliable. You're going to get the material from them in the future. Security of supply is hugely, hugely important. So, I mean, it's obvious they're putting out the numbers. Clearly, they're not exposed to these prices in a way that a shareholder would like to see. But that's obvious that that wouldn't be the case when the price of uranium goes from $50 to $100 in 4 months. No company is exposed to that unless they're selling purely into the spot market or have contracts they're delivering into that are 100% market reference. And all of the contracts signed 3, 4, 5 years ago that are being delivered into now were not 100% market reference. They at least had portions that were fixed, and that affects the realized prices of the company making those deliveries. So as time goes on, their exposure to higher prices improves, and the contracts they're signing now are extremely profitable that they'll be able to deliver on into the next decade. So I think they're doing an incredible job as a company. Obviously, it's been a huge winner in this market as a large cap liquid stock that has made an accretive acquisition with the Westinghouse deal. So it's one of those companies I think that are exciting to watch for the future. It's probably one of those stocks you hold and give to your grandkids kind of stocks. You know, it may not be super leveraged to the rising spot price, but that's not always the only reason to own something. So I thought some of the takes were a little bit harsh. I understand where investors are coming from, but you also have to realize that this company really took one for the team in a big way, with not only with maintaining and signing some contracts in the way that they did in the late teens, but by putting that mine in care and maintenance. And so I think it's really, it's funny to note that certain investors were alarmed by the fact that they have the potential to lose money based on the increasing spot prices, because if they have to buy in the market and the price go up $5 or $10 and they have to deliver into a lower price contract, that they actually lose some money on that, which is true. But to be alarmed by that and to not be alarmed by $10 million a month spend to keep McArthur River on care and maintenance for 4 years, you know, how you can't have both of those things. So I suppose I just wanted to express that I appreciate what they've done for the sector, and I think the company's going to be fine. So with all of that said, it's a very large cap company. Obviously, the investing sector can see that they're not super exposed to this rising price environment for this moment in time. And for the next couple of years, it gets better, but still. And perhaps we're in that moment, which I believe we are, where we're going to see possibly a bit of rotation, not necessarily out of just Cameco, but the larger cap stocks that have outperformed in this last leg of the market into the mid cap, smaller caps. Typically, that's how it happens in most resource bull markets, is you have the smart money position first, and the smart money buys what the only things that the smart money can buy in size, which are large cap liquid stocks. That's what moves first. That's what has moved first, especially in this last leg over the past year and a half. Now I think we are probably going to see a period where we see the small and mid caps outperform. And that's what we're expecting going forward.
Okay, I think there's a lot of points there to follow up on, and that certainly helps me understand your take on Cameco. One point that I wanted to pick up on there is, you know, the differences in the contracts that we saw signed previously and what we're seeing signed now that we're in this seller's market. And also, I think you mentioned a difference between, you know, a contract that Cameco might sign versus a company that is maybe a little bit less reliable. So anything more you can say there, because I think that's all very interesting for investors.
Sure. Well, I think the term contract elements are important to understand, because they give you an idea about not only what the company has the potential to earn going forward, but actually they tell you a lot about where the market is and where it's going. So the physical market, there's all these tells in the physical market. I mean, there's obviously what the price is trading at right now in the spot market. You can go on Numerica's website, you'll see the bid and the ask. If you talk with people in the sector, they'll actually tell you who's buying, who's selling, and at what price. And the spot market pricing that's reported intraday is relatively accurate for what's happening in the physical spot market. But it's the term market that tells you where the market is going, where it's been. So when it's a bear market for the commodity, so let's just say that was 2011 until 2016 is when we had the commodity really dropping in price. Of course, it fell from the spike in 2007, but the market was recovering. It was still very bullish for nuclear following the GFC, following the price where it peaked at 134, came all the way back down, I think, to 40, and then it started grinding higher again. And it was very bullish. The Chinese were building. We were still in kind of the tail end of that term market contracting cycle. And then Fukushima happened, and of course, we had a major hit to demand. all the Japanese reactors coming offline, Germany saying they were going to phase out nuclear, et cetera, et cetera. So that demand destruction is really what caused that bear market more than anything. But of course, at the same time, we had Kazakhstan's production continuing to increase all the way to 2016, where they peaked out, I think, 24,000 tons, about 62 million pounds. During that period of time, when it's a buyer's market, basically the contracts are primarily fixed. And the reason for that is that's what a nuclear utility wants. If you can get fixed price contracts, then you know what you're going to pay years into the future when that material is delivered, that you can budget around that, gives you a lot of financial stability. And that's what you want all day long as a fuel buyer. In any market, that's what you're going to want. You're not going to get it right now. But in a bear market, you had, if not entirely fixed, mostly fixed price contracts with, as the market started to turn, started to bottom, then you started to see an increasing percentage of those contracts be referenced to the market. Still, as we get 2016, 17, 18, we're still seeing, 60, 40, 50, 50 fixed price to market reference. And to be clear, market reference is basically at the time of delivery, you as the buyer, as a nuclear utility, you pay essentially what is the spot price in the market at the time of delivery. And then the fixed price portion is fixed at whatever you signed it at. Sometimes that's escalated based on inflation expectations, a couple percentage points a year, whatever it might be back then, a little bit more now. Getting into the recovery of the commodity, still, even though the commodity was bottoming, it bottomed at $18 a pound or just under, started to recover into the mid-20s, high 20s, 30s, into the mid-30s. Even at that point, because Kazatomprom was barely making any money. Cameco was not making any money at $35 a pound. Of course, they had fixed price contracts, and this is something that nobody wants to highlight now, is the contracts they signed, in the previous bull market, paid dividends into the bear market, right? So they made a lot more money than what the spot price would dictate as the price was declining. Now the opposite is true. Now we're getting into a market where the current contracts that are being signed and have been signed, let's say over the last 12 to maybe 18 months, are mostly, if not entirely, market referenced. And I would argue that the contracts being signed right now are 100% referenced to the market at the time of delivery. And what that tells you is that those that are signing the contracts, the producers, believe that the price will be higher in the future. That's all that really means, is they want exposure to where the price is going to go. So even though we've seen the price move all the way up above $100 a pound, you can look at the terms of the contracts to the extent that you can find out that information and understand where the market expects the prices to go. If you're signing fixed price contracts, you expect the price to go lower. If you're signing market reference contracts, you expect the price to go higher as a producer. All the producers are signing contracts that are mostly, if not entirely, referenced to the market with very high ceilings. So if you have a market reference contract, you're going to have floors and ceilings in that contract. The floor will protect you as the producer. So let's just say it's $100 a pound right now, or 102, whatever it is, 103 in the spot market currently. Let's just say you sign a market reference contract for delivery 2027 to 2032, and the floor in that contract will be $90 a pound, and the ceiling will be $130 a pound with escalation, meaning if we see large amounts of inflation, or you secure that at the time of the contract is signed, you'll see a 5% increase on that ceiling year over year until the time of delivery. So that ceiling is substantially higher than the current prices. That tells you where it's going. But also, if you put a ceiling in it at 130, that is something that you're essentially giving to the buyer to protect them from upside beyond that. So a ceiling tells you that both parties are actually expecting the price to go substantially higher than that ceiling. So these elements of these term contracts are actually telling us where the people who are buying and selling this stuff on a daily basis, where they're expecting it to go. Higher, essentially. One last thing that's important to understand with these contracts is that oftentimes, especially in a bear market, when the commodity is priced very low and or in a declining environment, the seller would give what are called flex provisions in a contract that would allow the buyer to, on their own volition, decide to receive more or less material than was dictated in the contract. Sometimes up to 20% more or less, depending on the contract. So, for example, let's say you signed a fixed price contract or a majority fixed price contract in 2013, and it was delivered in 2016, and the price went from $50 a pound down to $18 a pound during that period of time, and you signed a contract at $50 a pound, and you're getting delivered on in 2016, and the spot price is $18 a pound, the term price is 24, whatever, you're going to flex that down and elect to receive less material from that contract because you can just go and buy it from the Kazakhs or buy in the spot market for nothing. So contracts were flexed down during the bear market, and when that shifts and the price starts to recover, you see contracts flexed up. So contracts that were signed in 17, 18, 19, 20 that are being delivered on around now-ish and last year and next year that have flex provisions, the utilities are electing to receive more material because they sign those contracts at lower prices. And if there's any fixed price element to those contracts, which there were, then you're going to stand to greatly benefit by getting 20% more material than you initially signed in that contract for, than having to top up your inventories in the spot market at $103. So all of the producers that signed contracts, and there weren't that many, right? There's just a handful, the Uranium 1, Cameco, Kazatomprom, a couple of other entities and traders that say they signed contracts with flex provisions and partially fixed. Any time in the past that they're delivering on now, they're getting flexed up on. So what that means is material that is held in inventory by these entities or material that they potentially have committed out into the midterm, they're having to pull forward to fulfill these contracts that are being flexed up. So that flex up provision and the fact that utilities are exercising that option in that provision is vastly tightening the physical market in the present and in the near and midterm going forward. So it's making things even tighter for producers, basically. Very long story short.
Okay, for a market that is opaque, I feel like you pulled out a whole lot of information there for us. So thank you for going through that. The other thing that I wanted to touch on with utilities is, so for years we heard, okay, we have to wait for utilities to come back into the market. Now they're coming back in, and this is another place that it's hard to get a good view on. But can you talk a little bit about to what extent the utilities are back in the market? And I think I'm just wondering, we see them buying, but how much is there still left to do if we can know that?
Yeah, that's a really important question. So last year there was 161 million pounds, if I recall correctly off the top of my head, officially signed in contracts in the term market. It was the largest amount of pounds in over a decade in a single year. That's reported by UXC. UXC claims that they will report approximately 85% of the actual volume done in the term market. Sometimes the details of these contracts are not voluntarily provided to the price reporters, and sometimes they are. Most of the time they are, sometimes they're not. So we figured that was pretty darn close to replacement rate contracting, or the volume signed in the term market roughly matching the structural demand of the nuclear utilities globally that year. The interesting part is that most of that volume was signed in the European Union. Really big chunk in Ukraine. The EU utilities signed a decent amount of contracts. US utilities signed only 18 million pounds in contracts last year. Part of the reason for that is that they accelerated to a large extent the amount of material that they could receive from Russia, with an expectation that it's possible that that material could get cut off going forward. So they elected to receive, last year I think they received more material from Russia than any year, potentially ever. Went way above the limitations in the Russian suspension agreement. I don't know how they got around that, but apparently it's not really policed all that well. But it seems to us that the U.S. utilities are expecting this current legislation that's still waiting to be voted on in the Senate that will ban material from Russia to potentially pass. And if that passes, yes, they can get waivers going out into the future. It sounds like it's not necessarily an easy thing, but it probably would be granted. So this would be banned starting December 31st, 2027. They can get waivers from the Secretary of Energy. But there's always a risk that Russia, in retaliation for being banned, will say, okay, we're not going to send this anymore. We're essentially in a proxy war with Russia currently, if you can tell by the amount of money we're sending to Ukraine. So there's concerns around that. That's part of the reason why they did not contract as much and they pulled forward a lot of material from Russia. But with all of that said, there are very large uncovered requirements going forward. UxC estimates, if off the top of my head, 1.3 or 1.4 billion pounds of uncovered requirements going out to 2035, so in the next 10 years. Still, before the end of the decade, there's still 250 to 300 million pounds minimum that is uncovered. Now, that doesn't include what utilities will do to secure more pounds to top up inventories, to build out inventories. We still have a very large amount of uncovered material going forward. Utilities are mostly covered for this year. There's a few utilities, right? Utilities always think ahead because of the time it takes for material to move through the fuel cycle. So they're mostly covered this year. Next year, the EU is definitely covered. The US starts to be a little bit uncovered. 2026, a little bit more. So really, there's only a few years at the end of the decade where there's lack of coverage. But considering there's no material available until then anyways, if you go to Cameco or Kazatomprom right now and say, hey, we want material delivered in 2027, they're not going to have it. They'll have to pull it from elsewhere if they wanted to sign that contract. So the utilities are sold out mostly. Producers are mostly sold out of material going out to 2028. The converters are mostly sold out of material and conversion going out to that period of time. It's a very, very tight market in the near term. So we believe we're still going to see large amounts of volumes contracted this year and next year, and potentially another year after that. We're year one into the contracting cycle. And, the prices are going higher. It's a very interesting thing, this market, because you start to think, okay, we're at $103 a pound. The previous market topped out at $134. Of course, if you adjust that for inflation, that gets you to $200 a pound roughly. But the utilities were not big buyers at $134 a pound. A couple of utilities signed some contracts north of $100, but not very many. A lot of that was a speculative drive by financial players. This market is different. This is being driven by the actual end users of the market for the most part. Yes, there is some financial speculation in the physical market, but it's being primarily driven by the users of the material. And that is going to be the case for the next few years as well. We don't expect incredible purchasing from financial players just because there's not much material there. We're already hearing that these next funds that were supposed to show up at the end of last year and first couple of quarters of this year, which would be the PFYN fund based out of Singapore that was going to be buying material, ANU based out of Kazakhstan. As far as we understand, both of these are not happening. There's just no material in the market to buy. So it's so tight that any marginal purchasing in the spot market is moving the price. We're hearing very, very high price targets. I don't really like to make price targets because, especially right now, because the price isn't going to make sense for anybody. We can arguably go up another $20 a pound that will arguably incentivize every project in the world to be profitable. But the price is going to go far beyond that, simply driven by the substantially larger amount of demand than we have for supply. And so we're hearing, prices being thrown out there by the big banks that do analysis on the sector, by the B of A's and the Cantor Fitzgeralds, et cetera, that are looking for $130, $140, $150 a pound as a 12-month target in the spot market. Then you're hearing people like Guy Keller from Tribeca saying that's conservative. We're expecting potentially $170 a pound in the next 12 months. So the price isn't going to make sense. The price is going to be dictated by what the marginal buyer is going to be willing to pay, as they are going to be in competition with other entities interested in those same limited number of pounds. That's what we're about to see.
Okay, I think that gives a pretty good overview of where we're at in terms of prices. I want to go back. So we talked about Cameco and the market didn't love those results. We should also go back a little further in time and look at what happened with Kazatomprom, which released its results and its guidance for 2024. So people like that a little bit better because they're cutting their guidance for this year. And I think the question that I want to ask you there is the target that they've set for this year then looking realistic?
Well, considering that they revised it down to, I think it was 21.5 to 22.5 thousand tons, I think that that's possible. It's all going to have to be determined by how much well field development and sulfuric acid they're able to have delivered in Q1. Because we didn't see any increase in CapEx spend for well field development in Q4 or Q3. So we have an 8 to 12 month delay from well field development to actual production hitting the market. And if we don't see the CapEx spend, if you don't see the well field development, if you don't see a big jump in the amount of money that they've spent on sulfuric acid, then you're not going to see that production increase. There's no magic here. There's no fairy dust. You have to see those two things. You have to see either more wells being drilled and or more sulfuric acid being imported or produced in order to see that jump in production. So to just circle back really quick to Cameco, because I think it's important. I think the market's reaction primarily didn't have to do with the fact that that their realized prices were substantially below the spot price. I think they were reacting to the fact that they said they were increasing supply. They just heard more supply and they hit the sell button, and which is absurd because Cameco, first of all, Cameco owns the majority of both of those producing mines. One of them, I think, is the 70-30. The other one, I think, is 50-something, 40-something, if I recall correctly, with Uranium off the top of my head. So Cameco, where does that material go with their increased production? Which, by the way, this year, the increase is going to be relatively marginal. They're going to improve on Cigar Lake for sure, because part of that miss for 2023 had to do with improvements that they were making to the McLean Lake mill and automations they're trying to implement, having a little bit of kind of bumps in the road in that process. But they'll definitely produce above that 15 point whatever they produced last year, million pounds for 2024. Will they hit 18? I don't know. We'll have to see. MacArthur is going to be slower to increase, but they will achieve that in time. They have the capacity. They've got the ore. They've got the gradients. They have the mill capacity. They'll be able to hit that 25 million pounds. It's probably going to take 3 to 5 years to do it and a lot of investment to do it, but it'll hit it. Okay, so where do those pounds go? Cameco will tell you until they're blue in the face, we're not spot market sellers, and they aren't. I can confirm that with our contacts that actually buy and sell physical material. They don't sell in the spot market ever. They deliver into term contracts. So they are going to try to increase their production to the extent that they're able to in Canada. They're probably eventually going to turn on their production in the United States. It's not a huge amount of production, but it's pretty good assets. They might even potentially restart Rabbit Lake. They're going to do what they can to increase production because they're signing very high-priced contracts right now to deliver on into the next decade. You're talking about Cigar Lake Phase 2. My understanding is that is a bit more difficult in terms of grades, geochemistry than Cigar Lake Phase 1, but they'll still be able to produce from that. So that's Phase 2. That's late decade into the next decade. Who gets the rest of the pounds from this production? Orano. What is Orano's predicament? No pounds out of Niger since November. Okay, that's 5-6 million pounds a year that at this point isn't happening. Will that come back online? Will they be able to get pounds? I think so, but it's not looking all that secure there for them. Orano is definitely in a tighter position in terms of their production. You're not going to see any of their share from Canada's producing mines go into the spot market. So to run away and to hit the sell button because Cameco says they're increasing supply is irrational and just misinformed. Okay, back to Kazakhstan. So the situation there essentially is that they are prioritizing developing out this very large mine called the Budenovskoye 6 and 7. This is a joint venture with Rosatom. Rosatom owns 49% of that. That joint venture was pushed through in December of 2022, seemingly to the chagrin of various members of management. Kazatomprom, who left the company shortly after that deal went through. But this is a large deposit. It's going to produce, I believe, north of 6 million pounds a year eventually. It's a deep deposit. My understanding is that it potentially has higher levels of carbonate than some of their other deposits, which basically requires a bit more sulfuric acid on a ton per ton basis, the ton of sulfuric acid per ton of uranium produced. So it's a little bit more difficult. It's going to produce, but it's taking more acid, more time, more development money to get it producing. And as they're prioritizing that, and they're having difficulty getting more sulfuric acid from Russia, they have limited amount of production in Kazakhstan. So the company itself can produce 680,000 tons a year from 2 sulfuric acid plants, and they use right now about 2.2, 2.3 million tons a year, which is a lot. The rest they have to get from other producers in country, or they have to import it. The other producers in country have pressure from the state of Kazakhstan to prioritize the agricultural sector for that acid. Sulfuric acid is primarily used in the production of fertilizer. There's all these little elements to this that add up to basically a broad statement that mining is hard. Okay, that's the big takeaway here. Mining is hard. We don't have to think that there's some big conspiracy from Russia's influence, or there's some big conspiracy from Cameco to try to put a floor into the market and influence the market. Mining is hard. So what we're hearing essentially is, give you one example, rail cars in Russia right now. There's only so many rail cars. Sulfuric acid that's imported to Kazakhstan from Russia comes on rail. These rail cars are being prioritized for the war effort. They're not being prioritized to send acid to mine uranium in Kazakhstan. That's not their priority. So that one little element is affecting things like how much acid they can get. So in the meantime, until the sulfuric acid plant that they are going to build, they're building another plant. It's going to have 800,000 tons per year capacity, so it'll more than double their existing capacity for the company to be able to produce. They claim that will be online in 2026. That's probably a bit optimistic, but arguably they have every incentive to build that thing as fast as they can right now with these prices. Company like Kazatomprom is making so much money at $100 uranium. Yes, they're mostly producing and selling into contracts that are lower priced than the current spot market, but still, hand over fist. They have every incentive to develop that facility as fast as possible. Until that's operating and producing more sulfuric acid, they're going to have to rely largely on imports. So unless they can get more acid imported, substantially more, we're not going to see a production increase out of Kazakhstan. So what we estimate is if they can get that new facility operating in 2026, then they can largely increase the amount of sulfuric acid usage, not only in their existing mines, because if you slow down wellfield development, which they did last year, you have to use more acid to maintain production levels in those same well fields. It starts to deplete. It takes more acid to get the same amount of uranium out of existing well field. And that will continue until new well fields are built out. So they need more acid to maintain production if they're not expanding the well fields. We're going to see some well field expansion, especially for Budenovskoye 6 and 7, but it's going to take a hell of a lot of acid. So we're going to have to watch our financials quarter over quarter in order to make a prediction a year out for their production. So you got to rewind 3 or 4 quarters to see what they're producing now. Basically, is how that works in Kazakhstan. Last point I'll make: 70% of this new expanded production for the company is coming from Budenovskoye 6 and 7. That's joint venture with Russia. Russia is obviously seeing less demand from the West, and they have a very large build-out program. They need uranium. So what we understand is their share, so Rosatom's share, as well as Kazatomprom's share of that joint venture for that new deposit, all of that uranium is already committed to Russia for the first 5 years. So what that means is this big expansion that the market is expecting from Kazakhstan, almost all of that uranium is staying in the East. Kazatomprom is selling more and more of their forward commitments to China, and this big new development that is the bulk of their expansion is a joint venture with Russia. So this is not a relief valve for the West by any stretch of the imagination. So we need sustained high prices, and we need all of the U.S. developers to get their act together. Some of them are. We're going to need to start to see development of these big projects in Namibia that are going to take years and a lot of money to get them going. They're lower grades. They take they're lower grade open pit mines essentially. So there's some water issues in Namibia potentially that could impact these. It's not there's a persistent drought in the country, but also there's a decent capacity from the existing desalination plant that's there that's owned by the French. The Chinese are investing in another plant. It's going to take some time to come online. But my understanding is the infrastructure to deliver water from the desal plant or the reservoirs that are running kind of low needs a lot of work before we can see these big development projects really get going. It can happen. I'm not saying it's not going to happen. I think that there's some challenges, but I think it can happen. But we're not going to see new development mines in Namibia producing yellowcake minimum 2027 and probably 2028. So we've got this 3-4 year gap here where there's just no relief in sight on the supply side.
Okay, you're explaining it very logically. I'm glad you kind of put that conspiracy angle to bed, because I did have someone ask me the other day a question to that extent, and I spend a lot of time in gold and silver where we have things like that going on, and I was like, I can't handle this if it comes over to uranium. So great to talk about that. I want to go back just briefly to a point you made at the beginning about the equities and the movement that we're seeing. So you reminded us that, of course, usually we see those bigger, more liquid companies move first. Okay, that's what we've seen. Now it sounds like we're heading perhaps into a different phase of the stocks. So anything you can add there and what we should watch for?
Sure. I've been tracking something which I like to do these ratio charts. So I'm looking at a chart of URNJ charted against Cameco. So Cameco is obviously the primary large cap in the sector that everybody knows, and it has obviously seen a great run and a lot of flows. It's very liquid. And URNJ is an ETF by Sprott, the Uranium Junior Miners Index, and that doesn't hold Cameco or Kazatomprom. I think there might be one or two other larger caps that it also doesn't hold, possibly Paladin, if I recall correctly. I think UEC is its largest that it's holding. Which is still a relatively larger cap stock, but it doesn't hold the 3 or 4 of the largest in the sector. So tracking that, it's basically a big basket of small and mid caps, charting that against Cameco, and it's breaking out. We're literally probably tomorrow, we're going to see a golden cross on that, which is the 50-day rising above the rising 200-day moving average on the technical chart. So it looks like it's already happening. So that's kind of evidence that it is happening. It's not necessarily theoretical. We are seeing relative outperformance since December of the small and mid caps against Cameco and other large caps as well. So we're starting to see that. It's also just, the main theory around this is that as the story gets more popular due to its relative performance and it starts to attract more investment attention, let's say, you're going to attract a lot more retail investors, and the retail investors largely go after the smaller companies because they believe that there's torque in those companies, and there is torque in those smaller companies. Unfortunately, when risk is off, that torque is to the downside. When it's on, they can outperform by orders of magnitude. So that's what I think we're going to continue to see. Of course, it's not going to be a straight line up on a relative basis, but that is also what we did see in the previous market. And so there's historical precedent for it, or uranium specifically. Also, I know you follow other sectors, precious metals, other mining sectors. This is the case for most resource bull markets. The smart money goes after the big liquid stuff because they usually position first. And then when things get really frothed up and there's a lot of attention, lots of news stories, the sector really catches a bid, then retail kind of piles in and they just buy anything that has uranium in the name. And most of the time, that'll just go up. So, but URNJ, I think that fund is certainly helping the small and mid caps in that relative outperformance. And I do believe we're going to see more of that going forward.
The other point I wanted to make on the stocks is I seem to be seeing a lot recently when the ETFs do their rebalancings and things like that. It creates a lot of, I don't want to say chaos, but a little bit of turmoil among people trying to figure out what's going on there. And I wondered if you had any advice on how investors should look at that and should take that into account when they're looking at the market.
My advice is to ignore it. To be completely honest, every single time there's one of these rebalances, there's something that catches me off guard. It doesn't matter how much time I put into digging into exactly what's going to happen. It never plays out exactly like that. So you never know if the ETF is going to kind of nibble a week before the expiration of that rebalance, or if they're going to slam the market the last 5 minutes of the last day of the rebalance. I've seen both. It's, in my experience, for me, it's been a waste of energy to try to do anything around the rebalances. So my advice would be, don't trade around it unless you can actually very highly confidently determine that a stock that isn't held by it is going to be purchased by an ETF. In that case, you can speculate and buy it ahead of time because the flows coming from the ETF, not only just in the addition to the ETF, but there's clear outperformance by the stocks held by the ETF when we're in a bull market. And it's interesting, Charlotte, because even during the periods of time where the market has vacillated or has pulled back, we had multiple 30, 40 larger percent pullbacks. From intra bull market peaks to intra bull market troughs, we've seen a couple of gut wrenching pullbacks, and then we've seen a lot of periods of time where we've seen some chop. During those periods of times, the inflows largely continued into the ETFs. So what that means is even as the sector on balance is selling off, both the individual stocks and the ETFs, we were still seeing, in many cases, flows moving into the ETFs. So everything that was held by the ETFs, generally speaking, didn't sell off as bad as what wasn't held. So some of these small cap explorer stocks that haven't been held by the ETFs are down still very substantially from, let's say, the November 2021 highs. Whereas if you look at the large caps and the mid caps that are held by the ETFs, most of them, all of them, if you look on a market cap basis, that of course the share count has increased since that period of time for most stocks. But many of them are at all-time highs, if not multi-year highs, and definitely higher than that previous peak, which they should be at $103 a pound uranium, for God's sake. But if you can recognize that a stock isn't held by an ETF and it's about to be held by an ETF, that's the type of speculation. As far as trading in and out based on expected buying or selling, that's a game I don't play, and I would advise against it, generally speaking.
Okay, I have one last question for you before I let you go. And, before we had turned the camera on, you're talking about how there is a tendency right now among uranium investors to be looking for the next catalyst. And I kind of laughed in my head because I'm totally guilty of that. I'm sure I've asked you before in previous interviews what's going to be coming next. But, you had some resistance to that. Maybe we don't need all these new catalysts or brand new things. So maybe we could end on that note, what you're seeing there and your thought process around that.
Sure. I mean, catalysts are important, right? If you can recognize an upcoming catalyst ahead of time, you can either be more confident in holding your positions, or you can have the confidence to add to positions or to make initial purchases of positions prior to an expected catalyst. One of those, of course, was the recent news from Kazatomprom. They unexpectedly gave the market a nod about a month before that trading update, letting them know that they would likely be revising down their guidance. And we expected that multiple months ahead of time. They released in September of last year that they were revising down their CapEx for 2023. So that's very clear to us. If they're revising down their CapEx for the year, it wasn't theoretical. They will not hit 25,500 tons. There's just not going to happen. They're not going to see a 20% increase in production if their CapEx is diminishing. So that was very easy for us to recognize. And of course, we made that clear to, in multiple public interviews, but also to our membership, like they're not going to hit that. And they're going to have to tell the market that they're not going to hit it. And usually that happens in early February. We didn't expect that news in January, but luckily we recognized that months prior. So that helped us hang on, after the move that we saw September, October, into November. We had a pullback in December. Hang on through that period and add to positioning with high confidence that news was going to come out. So in that sense, we perceived that as a potential catalyst to not only move the equities, but also move the price of uranium, which it did, both of those things. So I don't want to say that catalysts aren't important, but I think that a lot of retail investors in the space know the story decently well from the previous bull market, which really the story back then was the Chinese were talking about vastly expanding their market, and they were coming into the term market pretty heavily. Nuclear was growing. The price was starting to move up on all of that news after bottoming and going through a brutal bear market leading up to that as well, from the spike that we saw back in, the 70s and the early 80s. And then went, price declining and chopping sideways for a decade and a half. So this price started to move up. That started to get investors' attention. But what does everybody know about the previous bull market? Cigar Lake flooded. All right. That's the only thing that a lot of people know about that market. And then the price went nuts. It did. The price jumped, but we already had a recovering bull market before that. That just basically gave the market a perception of a supply deficit situation. We didn't actually even have a supply deficit at that time. We had enormous secondary supplies, not only coming from kind of the earlier years of gas centrifuge enrichment that was ramping up at the time, and some underfeeding from enrichment, but we also had megatons and megawatts still until 2013. This is 20 million pounds a year secondary supply coming from downblending of nuclear warheads. So we had a far more of a secondary supply buffer in the previous market and no actual real structural supply deficit. It was minimal. But that flood, along with, I think there were 2 floods, if I recall correctly, and there was an impact to one of the producing or developing mines in Africa with some weather event there as well. But that was a catalyst that did move the price. And it feels like, to me, investors are, and to their credit, this is a long bull market. It's already been, what has it been? It's been almost 8 years since the bottom of the commodity. And the equities, generally speaking, have moved up along with the commodity. But we had multiple years from $18 a pound to 30 something where the equities were sideways to down. I was exacerbated by just general equities markets and, of course, COVID. So the equities, this has been a long market. And if you've been holding on for those period of time, especially if you didn't choose wisely in the securities you hold, you're probably like, damn it, when can we just have something blow up and make this sector moon so I can retire? And I feel like that's a largely held sentiment in the sector of like, people just want the conspiracy theory. They want the mine flood. They want the Kazakhs to miss and to decline production in a big way. They want another event in Cigar Lake or MacArthur River. And we don't need any of that to happen at all. We don't need any more catalysts. We've got a 30 to 50 million pound supply deficit in the market, probably for the next 5 years. That's what we're looking at. And that's what's going to move the price. And I especially feel like I have that sentiment now because of being an advocate for the industry as well. Those two things don't have to be butting heads. You can be a nuclear advocate and also want the price to go up. In fact, you should want the price to go up. We need sustained prices in order to, I'll just say we need sustained prices probably north of $200 a pound. Why? Because that will incentivize innovation in the sector, because there's no way in hell we're going to be tripling nuclear energy by 2050 to meet these like expressed targets at COP28 last year, unless we have new ways of sourcing uranium. It's going to be very, very difficult to mine 350 million pounds a year out of the ground in uranium mines when we've got 135 or 140 right now. So seawater extraction, phosphate tails, phosphate mining in Morocco, whatever. Those are probably the big ones that I think are going to happen in the future in order to really support this industry for the rest of the century. That's what I'm pulling for. I'm not pulling for a measly $150 a pound so that we can get, all the Namibian projects and the US ISR projects online. No, we need that, and that is going to happen. But what we really need probably is much higher prices. You can have both things. You can pull for the industry, you can pull for higher prices, and you don't need to pull for some cataclysmic event that's going to send prices on a moonshot. So I would just say, keep the big picture in mind, keep the long term in mind. There's a protracted supply deficit that lasts as far out into the future as we can see right now. And if you want nuclear to continue to expand, we want these projects to come online. We want new supply. We're going to see high prices either way. So there's my bar mitzvah speech for the day.
Okay. I think definitely food for thought. I hope people have stuck around to hear that at the very end of the interview. Thank you so much for going through that. I think it's a good point to wrap up.
My pleasure. Thanks a lot. Nice talking with you again.
Always good to see you. And once again, I'm Charlotte McLeod with investees.com, and this is just Huhn with Uranium Insider. Thank you for watching. If you like this video, make sure you subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below. We'll see you next time.